Zomato is also down another 5% in trade today as well. So just look out for what that does in trade and how it pans out from here. But let's shift focus. Let's talk about what's happening with metals. Let's try and decode the commodity route, which is currently playing out. Iron ore prices, remember, continue their retreat. In fact, they've tanked a good 50% from their record highs. So let's try and understand what really is going on here. We have with us none other than Mr. VR Sharma, the MD at JSPL, joining in at the show right now. Mr. Sharma, good morning. Great to have you on the show. Just wanted to understand what's happening here. Why such a rapid fall in some of the ferrous metals and iron ore in particular? It's a 50% steep fall that we've seen from the record highs.
Yeah, good morning. The iron ore has played definitely a very important role in overall reduction of the stock market. Internationally, the iron ore was about $220 2 months back. And there was a steep fall, came down to $130, $140. But on the contrary, the coking coal prices have firmed up. These are still at $225 to $230 FOB Australia. That is a benchmark. But there is overall a little depression in the minds of people that the steel prices or the commodity prices or the metal prices may go down. But it is unlikely that the prices will go down. Reason being because the other input cost like ferroalloys and the coking coal is still at its peak.
Okay. Steel, though, Mr. Sharma, on the other hand, has relatively stayed resilient as opposed to what's going on in iron ore. In China, prices are still above $800 to a ton, despite the virus re-emergence as well that one has seen in China in pockets. What's aiding this, and do you think this uptake and resilience that one can see in steel is here to stay?
Yeah, the steel prices in China are as following. Number one, the semi-finished, you are right, about $800 a ton. But whereas the finished material, that is hot rolled coils or the specialty plates, these are still at about $1,050 to $1,080 a ton. So this is a very good price as far as the overall steel scenario is concerned. With a very low price of iron ore today at $130, $140, having prices of more than $1,000 steel finished goods, it's a very good price. So they are going to earn a lot of profits. So metal market is going to be stable.
Now, there is a supply and there is a demand. While demand is strong, when do you think additional steel capacity will start kicking in from you and from the industry?
Yes, you are right. When demand is strong and the overall IRR is better, then definitely the new investments and new capacities, they do come. And this is what's happening in India now. If you see the 5 major players in India, they have declared project worth about 2 lakh crore rupees. So this is something very positive news because India has to reach to a level of about 300 million ton by 2030. Just 9 years later, we'll be producing about 300 million ton steel and we'll be consuming same quantity. So the overnight, it is very difficult to build up the capacities. So to build up capacities takes about 3 to 4 years time for a small plant about 3 to 5 million ton. And if you have to add facilities more than 3 to 5 million tons at a particular location, then the time consumed is about 7 to 8 years overall. So all of the steel mills, whether it is JSPL or JSW or SAIL or Tata Steel or ArcelorMittal, everybody is very bullish. Everybody wants to invest in the country and put together a 2 lakh crore investment is likely to come in next 4 to 5 years time, which is a very healthy sign. And over and above, the demand is also picking up. We feel that the steel will definitely shine in times to come in much better way than it is today.
If iron ore prices have come down, why do you think steel price or finished steel prices will not come down?
You see, today the prices are holding only because of the coking coal, because most of the steel is produced in the blast furnaces route in the country. And the other is the scrappage policy which has come. The scrap availability as of now is very, very low. We used to import about 8 to 10 million tons scrap in the country. Still, we are maintaining the same tempo, 8 to 10 million ton. Unless the entire country comes in this scrappage policy and the scrap start its scrapping units, they start production, there will not be any respite. Over and above, the electric arc furnaces in the country are very less in numbers. We have to put up more and more electric arc furnaces so that we can utilize and use the scrap which is going to be produced in India. So we feel that in times to come, 10 million ton imports and about 10 million ton local scrap. So total 20 million ton scrap will be available. Of course, this will also address to the ESG issues and overall CO2 emission reduction plan of the government of India. But unfortunately, the energy cost is very high in the country. Still, the prices are about 10 to 12 rupees per unit, which is a very high price. We consume about 600 units per ton for steel making. So 7,200 rupees to 8,000 rupees is the energy cost, which is very high. It's not viable in terms of producing steel through the blast furnace route versus electric arc furnace route. I think Government of India will have to come out with a comprehensive policy where one tariff, one nation scheme will be applicable, and the country should get power from Kashmir to Kanyakumari at ₹5 per unit. Then only these the electric arc furnaces will be viable in different part of the countries. So overall, if you see, the steel demand will continue because infrastructure projects are offering, and there are not many projects on the table now. The construction sector is booming, and the shipbuilding sector, defense sector, and the oxygen cryogenic plants, as well as the cryogenic storage tanks, they are definitely increasing in terms of numbers, and overall growth is superb, I would say. So the consumptions will be maintained, but the prices can only be reduced if the coking coal prices come down from $220 to about, say, $120 or $130 a ton. Then definitely this will impact the overall pricing in the country.
What will be your pricing in terms of the fixed contract versus the spot market pricing? Last year, if you followed the spot market, it was like a lottery. This year, are you likely to take a risk of keeping your production open to spot market more and less fixed price?
Yes, we are still maintaining about 35 to 40% in the spot market. The spot market is still very remunerative. So if you see in the international spot market, that is hovering around about $900 a ton to $950 a ton for the finished goods. And for semis, it is still about $680 to $700 a ton, depending on the size, grade, and chemistry of the material. And this is a very good price, I would say, when we compare with the Indian prices. So there is earlier it used to be about $200 to $250 a ton of difference in domestic and the spot international prices, but now it is about $100 a ton. So still it is good to export. So we are exporting about 35 to 40% of the total steel, total produce in our company. And I think my other peer group also, they are maintaining about more than 30% of the total sales. That goes to the spot market in the international markets.
Okay, hi Mr. Sharma, this is Mubina as well joining in. Just to pick up on something that you mentioned in your earlier answer, and that's that steel prices will reduce if coking coal comes down. So the first question is, what is keeping coking coal elevated? What's the supply situation like right now? And I think the last time I checked, the print was at $250 or $260 per ton. This is the highest ever. It continues to stay over there despite the whole rout that we saw across commodities. So what do you think is keeping coking coal, ferroalloys as well at that higher level?
Yeah, thank you. So you look, the Chinese steel industry plays a very significant and vital role in maintaining, reducing, or increasing the prices. They produce 1,050 million ton of steel, which is a very huge quantity because they are doing about 60 to 65% of the total steel production in the world. So whenever they change some policies, that definitely impacts the whole world. And this is how we call that China has become a world workshop. So how it has become a world's workshop today, you are seeing that hundreds of vessels are waiting in the South China Sea because of the COVID situation or because of the quarantine. You are seeing the silicon chips are not available. the downstream industry in India or anywhere in the world is affected very adversely. So similarly, the coking coal, Chinese, they stopped buying coking coal from Australia and they started buying from Russia, from Venezuela, from Colombia and South Africa, and also from America. That has imbalanced the entire world. The reason is because they are now importing from Western countries, including America and Canada, and the rest of the world is banking upon Australia. So there is a crisscross movement in the Indian Ocean. So the Indian Ocean is now full of vessels having coking coal from America, Russia, and from South Africa, from Colombia, is bound to go to China. And the European companies and American companies, or the Latin American companies and Asian companies like India, we are importing coking coal from Australia. So it is a crisscross movement of the vessels. So that has also played a very adverse impact on the overall prices in terms of the shipping cost. Shipping cost has increased. The daily demurrage cost has gone up 4 to 5 times. It used to be about $8,000 to $10,000 a day. Now it is $30,000 to $40,000 a day. In some of the cases, it has gone even as high as $60,000 a day. So, the Chinese policies are such that they can disturb the whole world. So we have to see that what is the right way. And for a country like India, the only solution is that we should use our Indian coal, which is called Swadeshi coal, high ash coal, through the coal gasification route, and then finally making DRI and using DRI into electric arc furnaces. We can reduce the carbon footprint by at least 60% if we utilize Indian normal coal, high ash coal, convert it into gas, that is syngas to DRI, and DRI to electric arc furnaces. I think that's the answer. Otherwise, such kind of cycles will come in times to come also. So next 20 to 30 years time, we should be in a position to use maximum Indian coal, which is very, very environmental friendly if it is gasified. Otherwise, such kind of ripples will keep on seeing in times to come also.
Okay. That's a very interesting take that you've given us. Let's not forget that China still has a bit of a tiff with Australia when it comes to their trade, and hence Australian coking coal is not reaching China. And this in turn has created a bit of a crunch as well overall, because shipping costs have increased quite substantially. Mr. Sharma, now, like you mentioned, China's policies, their exports have reduced considerably, and, their output as well is going to be a little on the lower side. So that means exports will continue to be low for the rest of the year. Indian steel mills have been exporting, like you mentioned. How well do you think Indian steel mills have captured the gap left by the Chinese?
Yeah. So what has happened, I'll take you to the Chinese internal policies, what they have declared to their industry. They have reduced production from the mills, which are generating more and more CO2, that is more than 2.8 ton per ton of crude steel. And that capacity is expected to be about 200 million ton. So out of 1100 million ton of total capacity, they will reduce it to 900 million ton. On the contrary, what they will do, their total overall consumption will not reduce. They used to export about 100 million ton. So they will not be exporting 100 million ton. Maybe they'll export 10 to 20 million ton just to maintain the presence. So if you see the out of total 1050 million ton of total production, so they will be exporting maybe about 20-30 million ton. Balance will be consumed within the country. So the net gap is about 200 million ton. So this 200 million ton gap will be bridged by them by importing semis. So like billets, pig iron, blooms, slabs, and semi-finished goods. And for that, there is a big potential existing in country in India, because we are the nearest steel producer to China. So our vessels, they reach in 7 to 8 days time. And the next beneficiary can be Iran, because Iran is also coming in a big way. But because of the sanctions on Iran, not many countries are buying from Iran the steel slabs or the semi-finished. And the third largest exporter could be Ukraine. But Ukraine, it has to pass through all the way Black Sea, and then finally it has to come to Canal Suez. And there is a huge congestion on this particular route. And the traffic is so much, and the vessel availability is a big issue. Today, the vessels are charging about $50,000 to $60,000 a day, the tariff. I mean, that was unheard in past. So that will make the goods very expensive by the time this reaches to China. And finally, what will happen? The countries like India, Iran will definitely reap in the benefit, and they can increase their production, enhance their production for the world market. We have bridged the gap in terms of exporting material to the customers of China. Like today, we are exporting most of our goods to Southeast Asia, which includes Philippines, Indonesia, Malaysia, and Thailand, and also Australia. And part of the products we are selling into Middle East, that is Saudi Arabia, that is UAE, Qatar, Oman, Bahrain, Kuwait. So that is another market. So for Indian steel producers, is a very good time, I would say, that we can maintain a perfect balance in between export and import. We can make a perfect balance in the spot markets and the domestic market. We can still maintain a very good price for the exports, and we can also maintain a concessional price for the domestic market, so that our domestic consumers, MSMEs, and other OEMs, they do not suffer for the want of steel. And steel import in country, I mean, it is a very distant dream. It will be very difficult now.
Correct. All right, Mr. Sharma, really appreciate you joining us today. Thank you so much for your time.